and they should work. If you think it works, it should work in both periods.
But how do you interpret? End of the day, you will be still reporting. That is the difference between technical analysis research and fundamental analysis research or macroeconomic research. Is that when you have a TA result, it's normally you report it, but how do you interpret or how do you try to give some intuition in terms of interpretation of your result?
Yeah, that is a good point. Apart from looking at the market trends, there is also, you can back up your findings by looking at theories, for instance, behavioral finance, which can guide, but then you need ways of proving those theories as well. You can't just state them.
Like for example, if in one, like in the moving window approach, for example, if you think that adaptive market hypothesis work, okay, so you try to predict the next period's trend based on the current trend, and you move it once. I mean, maybe revise the strategy once a year. So let's say that you found 5% drawdown when you sell the stocks, and then when you have 5% draw up, you buy the stock in the first period. The next period changed. But then, for example, you figure out a particular way that actually works. How do you interpret it? Or how do you intend to interpret it? That is the difficult part of doing any technical analysis. An easier way is that always relate your results to the different stages of the economic cycle. Alright, and then for example, it's very similar to overreaction hypothesis. Maybe you will find that the revision is during the market crash, for example, and then you can find that more revision is required, or for example, TA does not work too well during a certain period. Or for example, in the upswing of the economic cycle, the TA doesn't work that much, because every time when there's a drawdown, it's probably better you just have a buy and hold because it's going to bounce up very, very fast. Yeah, like for example, so try to relate your interpretation to the economic cycle, or for example, a certain stage of the economic shock. So basically, you have to look into what happened at each stage of time. Yeah, that is probably the most efficient way in interpreting your results. Otherwise, no matter how you report it, it will still seem like it's a data mining process. Okay, so that's my first comment. And secondly, you download the data with open high, closing low.
Yes.
What do you intend what do you intend to use those information in your research?
Mainly, I look to use the open price data, like because when you, as we have discussed this, when you have like a signal generated, the next price that you purchase it is not at that current price, but the opening price on the next day.
It could be.
It could be, yeah. Alternatively, you could have used the next day's closing price, but then that shift in one day can be too large, and then you can lose all your profits as well.
Okay. So basically, what can be done, and based on something that is stated, is that, traditionally you find the TA articles, you found that they actually all work very, very well. TA works very well. All right, and then, but it never take into account at what price that you are buying or at what price that you are selling. Okay. The most conservative way is that always assume that you sell in at a low price, but when you buy the highest price of that. So basically, it's a kind of stress test, okay? Because I can give you a very simple example. When I developed a hedge fund product in Taiwan, I could accumulate something from 1 rand to 165 rand in 10 years. Okay, that's a tremendous amount of return that you can generate every year. But by simply applying a 2% transaction cost, that is reduced to about 10 times only. Oh. Okay, so it's very, very volatile, or it's unreliable for you to run a technical analysis without trying to look into the bid and ask spread, or at what price you enter into the market. For example, when we know that when there's a 5%, when the previous index dropped by 5%, then basically you quit the equity market and go into cash. Right, buy the treasury bonds or whatever. But how likely is that when you detect there's a 5% decrease, and then you will be able to sell your stock the next day at that exactly the same price? It probably doesn't. The next day it can actually drop by 10%. So your entry price to sell the price is probably 15% lower rather than just 5% lower. The same as when you get into a hot stock. Okay, you think that the market bounced back by 5%, but your purchase price is probably 20% above that. Okay, because there is always a delayed response. Okay, And investors learn very fast as well. So, I mean, not only you are trading, everybody else also using similar rules. Especially TA rules are very easy to implement compared to consolidate all the data from the financial statements, trying to look ahead bias, construct your variables, and so on. TA models are very easily to devise. For example, if you got Bloomberg, okay, it's lifetime and they have a lot of set up models already with different thresholds. So everybody is doing it. So if you don't assume a more prudent or conservative approach in testing your model, it's more likely that you have a good in-sample, but you're actually having a very bad out-sample. Okay, so that's important. That is why you need to have open, high, close, and low. All right, because traditionally, the researchers just rely on the closing price, not anything else. Okay, like what I said, the most conservative way is to test whether the model still works when you enter to buy at the highest price of the day and then sell at the lowest price of the day. And I can tell you from experience, most of these TA method does not work, which does come into the importance of what you propose to use the tactical allocation method. Because in terms of tactical allocation methods, we are not trying to test just the TA rules. Okay, we are actually intended to manage the risk. Okay, rather than basically generate more returns, like, you know, could the market go into cash and then you rebound back 100% into equity. We don't do that, okay? So you can actually tactically allocate that maybe a 20% threshold of gradually allocate the money into the relevant sectors. And in that way, it's actually all your research is also more backed up by macroeconomic conditions or, for example, the performance of different sectors. So there is fundamental backing on it. So when you do the interpretation, it's easier. Yeah. And then,
sorry.
Yeah.
But does that mean he needs to hedge those risks? Because if he's going to look in I know, I mean, obviously you're going to have to factor in your transaction costs.
Yeah, you have
so
to know that.
It wouldn't make any sense
No,
if markets are going to change.
You do hedge. What happens once the market starts going down? You hedge that position. You move into cash.
Okay, so you are going
Yeah.
to.
That's why the risk-free T-bill rate is there to hedge your position.
And you also not completely putting 100% of equity, trying to bet on the market, like a traditional 100% TA thing. That you're trying to test the TA strategy that you go into cash or you bounce back to equity. Because transaction cost and the bid and ask spread, that the impact you suffer is a lot. But in this case, when you do the sector allocation, or for example, it's a gradual movement. So those impact of transaction cost and, for example, the betting on the equity or cash is less in terms of the transaction cost as well. So then you mentioned that the tactical allocation, okay? I mean, now you are the first one using the charting method, using that. I mean, but what was used before? What have been tested before?
The draw up and draw down methodology has been tested before, and also the exponential moving averages have also been used. Some studies have also used momentum as one of the factors to determine when to go in and out of markets. Some studies have also looked at macroeconomic variables to determine when to buy and sell.
But whatever you are doing, because you're just allocating different percent, maybe 60% into a particular sector and 20% into something else, and the other remainder going into something else. When you are doing a technical sector allocation like that, it's actually a semi-fundamental and technical, like a hybrid approach. So it basically is something new, which is nice.
So how do you decide what is the optimal sector?